Poised for Exit is a show for business owners who want to achieve a successful exit based on their own terms. Your business exit will likely be the biggest financial transaction of your life, and for most, you'll have one shot at doing it right. The topics and guests we feature and the stories they share will provide valuable ideas and strategies to improve operations and grow enterprise value so you can achieve the best possible exit outcome. Now here's your host, award-winning certified exit planning advisor, Julie Keys.
Welcome, everyone, to the Poised for Exit podcast show. Today's guest is a board-certified M&A intermediary who's going to be talking with us about some things you likely didn't know about business valuation, something everybody's interested in. So we're going to hear from him right after these messages.
My name is Todd Crow, and I'm the president of the Twin Cities Exit Planning Chapter. If you're a business owner and advisor and want to learn more about the world of exit planning, you're invited to visit the Twin Cities chapter of the Exit Planning Institute. You can expect top-level education delivered by subject matter experts at every monthly meeting. Grow your network and draw from the learning that could be a game changer for your business or your practice. There's no pressure to become a member, so come and see what the buzz is all about. Our meetings are held the second Wednesday of the month, 7:30 to 9 a.m. See the show notes for more information and registration links.
Thinking about selling your business in the next few years? Don't wait to start planning. I've seen too many business owners wait too long and regret it. Freedom Financial Partners are financial advisors who specialize in exit planning for business owners, helping you reduce tax surprises, protect what you've built, and quantify how much you need from the sale. Their proven process helps you think beyond your business so you can move forward with clarity and confidence. The longer you wait, the fewer options you may have. Download your free financial readiness assessment today at ffpforme.com/exit. That's ffpforme.com/exit. Are you a business owner getting ready to transition? If so, I recommend True North Mergers and Acquisitions as your confidential strategic partner. They understand your business sale isn't just about one buyer and the price, but what you net that counts. In other words, what you get to keep. When you're ready for a higher level of representation that delivers consistent results, contact True North M&A to do the heavy lifting of selling your business. Learn more at tnma.com. That's tnma.com.
Exiting your business is a big deal, both financially and emotionally. I'm John Marquet, Certified Exit Planning Advisor with TrustPoint. We help business owners transition smoothly on their terms. Our focus is on maximizing value, minimizing stress, and giving you confidence in what's next. Whether you're selling or passing the torch, we make the process seamless. Start planning today at trustpointinc.com. That's trustpointinc.com.
Hello, Poised for Exit listeners. We are here today with Jacob Petersen, who's an M&A intermediary with Murphy Business. Jacob, welcome to Poised for Exit.
It's good to be here. Thank you.
Thanks for joining me. I believe we met several months ago at an EPI chapter meeting, and you traveled from Rochester to come to the chapter meeting, which I thought was really cool. And I just really enjoyed our conversation and found that the work that you're doing as an M&A intermediary alongside numerous credentials and your differentiator made it kind of compelling for me to have you on the show and talk about the work that you do, not only in helping people sell their companies, but also in the valuation work that you do. And I think that there's a lot about valuation that we can talk about today, which I believe we will. But before we get into all of that, let's just talk about you and how you got started, because obviously, like I said, you got all these credentials and you've been around, so I'm sure it's an interesting story on how you got to where you are right now.
Sure. Yeah, no, thank you for having me on here, and happy to help your listeners here. So I started out as an auditor at a big accounting firm in Rochester. I actually got laid off in 2009 during the economic kind of catastrophe that was happening there. And I picked up a job as a business manager at a very big church. And I was working there for a couple of years. And during that period, I kind of turned from being a full-time person there to making that a part-time job. And then I started an accounting practice, was working on small businesses. I literally helped hundreds of businesses get started, and I'd do their books for them and payroll. And in about 2016, I got a call from my current broker that I'm working with right now. And he said, "Hey, people like you make good business brokers. You ever thought about being a business broker?" And I said, "Yeah, actually, I have." So we actually ended up selling my accounting practice. Before I sold the accounting practice, we actually built it up. We bought an accounting practice, and then we ended up selling it. And I started my business brokerage. So I've bought and sold businesses myself. And I've been doing the business brokerage thing here for just about 9 years now. Like you said, I got my MBA back in 2010. I got my CPA also in 2010. Just recently, I got the certified board intermediary and my CIPA designation. So trying to get some of those professional credentials just to kind of stay on top of trends and be a resource for my clients.
Excellent. Well, you certainly are a resource for your clients. So, we were talking before the show about small business and profitability. Um, Business owners sometimes have misconceptions about what their business is actually worth, and how to calculate true profitability. So, from your perspective and in the work that you do, let's just talk about the different metrics that you use. I know EBITDA is one, seller discretionary earnings. Let's talk about that first before we dive into the rest.
Sure. Yep. So when we're talking about kind of smaller businesses, it's called seller's discretionary earnings. And the reasoning behind that is what is the cash flow that the business generates that the owner is able to use as they would like. So basically, usually you start with a tax return and there's, okay, on my tax return, I make no money because I don't want to pay any taxes. And then you go, and then you go to, okay, well, you're taking $100,000 salary and you've got $40,000 in depreciation. And maybe you bought a business or a client list, you got $10,000 in amortization. And maybe you've got a loan and so you're deducting interest, and so all those things you might add back where if so you go from zero and then you add the salaries, you add the taxes related to salaries, you add the interest, depreciation, amortization. Maybe you're actually got a $200,000 cash flow or a $300,000 cash flow. So there's kind of the other aspect of that is also discretionary items. So what I like to tell people, and normally I don't see, but I like to think about is, hey, if you take a corporate trip to Vail, and you don't need to go to Vail, but you do it anyway because you can. Well, maybe we could add back that $10,000 of hotel and ski passes because it's discretionary, right? You don't have to do that as the business owner. So you also got to look for those buried discretionary items. So maybe you're at 250 of cash flow. So you figure out, and that would be your seller's discretionary earnings. So you get rid of all those discretionary items or what I call tax planning items to get to the real number of the cash flow. And the difference between EBITDA and SDE is basically the salary of the owner. So SDE is for an owner operator. It's for the cash flow that somebody would have if they're going to run the business themselves. EBITDA would be the cash flow for somebody if they're not going to run their business themselves, if they're going to hire a manager to run the business. So let's say your cash flow is 300 SDE, but you got to pay $75,000 to pay somebody to replace
Right.
the owner or to be the manager. Then your EBITDA would be 225 grand. And as an example, let's just use those two numbers as an example. Let's say your SDE multiple is 2. Well, your business is worth 600 grand. And if your EBITDA multiple is 3, so it'd be 300 grand times 2 would be 600,000 of value. EBITDA is 225 times 3 is going to be 675. So you can see that even though you got different metrics, the multiples adjust for those metrics, and the valuation with a good business should end up about the same no matter what, if you're using EBITDA or SDE.
Interesting. So, do you have like a rule of thumb, in your opinion, on thresholds between one or the other that you prefer?
It really comes down to how close the business is to being professionally managed without
Sure.
the seller.
Right.
So, if you've got a business where the seller works 15 hours a week, 20 hours a week, I'll lean more towards EBITDA because generally that seller is not, they're able to be replaced. They're doing the books or they're doing the HR. And so you can replace them really easily. If you got a business where the seller's working 40, 50, 60 hours a week, they're probably not easy to replace. And so I would lean towards the SDE.
Yeah. Well, and we know that, owner centricity is definitely a problem with a lot of small companies across the country and across the world, actually. I mean, I actually have people that I work with in other countries, and owner centricity is a problem everywhere, right?
Mm-hmm.
But before we dive into some of those complexities, maybe we could just talk about some of the valuation misconceptions that owners seem to have that you've run into in your career.
Sure. Yeah. I mean, there's kind of two major things that I run into pretty often. One is this question of somebody says, well, what's my customer list worth? Right? What
Mhm.
is my phone number worth? And they think, oh, I've got a customer list, it's worth $100,000, right? I've got a phone number, it's worth $25,000. And from a business buyer's perspective, as somebody, for me, as somebody, an intermediary who's trying to build a bridge between a seller who wants something and a buyer who wants something, it literally comes down to cash flow. So your customer list and your phone number and all of those intangible assets are actually inherently a part of your business, and your business is valued based off the cash flow. So if you're getting 1,000 calls a month and you still can't make any money, those 1,000 calls a month aren't worth anything, right? So there's no inherent my customer list is worth X. It's related to how much cash flow you can get out of your customer list, how much cash flow you can get out of your phone number. The other misconception, so it goes back to that kind of multiples on SDE and EBITDA that you get from those items. The
Sure.
other uh, misconception that I get is I'll do a valuation for somebody and I'll say, okay, your business is worth $500,000. And they say, okay, great. And then I add my equipment value and I say, no. So basically the way that I illustrate this for people is I say, let's say that you're a new owner of a business and you show up on day one and you got no equipment and you got no inventory. How much money are you going to be able to make on day one? And of course, you look at the seller, the person who owns the business, say, well, I'm not going to be able to make any inventory. I'm like that. I'm not going to make any money. Say
Mhm.
exactly. Your business is worth nothing without the assets that are required to run the business and without the inventory that you need to do the work. And so when I do a valuation on a business, it includes the intangible value, so the customer list and the phone numbers and your workforce, those sorts of things. But
Mhm.
it also includes all of the assets that are needed to run the business and a normal amount of inventory so that on day one, when the new owner shows up, they can start making money right away. So it's not a sum of the parts deal where it's like, okay, my phone number's worth X, my equipment's worth Y, my inventory's worth Z. It's no, it's all of those things together are worth one thing, one number.
Sure. Yeah. So what about industries though? Like, doesn't that, like when you talk about inventory and equipment and stuff like that, that doesn't always apply to every industry. Do you have specific industries that you focus on, Jacob?
Yeah, well, so in my work, I do all sorts of businesses. So the bummer is like you said. So I'll give you a prime example. I ran across I actually listed for sale a landscaping business. They did landscaping and snow removal, and I did the valuation, and the value, it was made about 150 grand. My valuation on it was like 325, let's say $325,000. And
Hmm.
the owner looks at me and he says, well, I've got $650,000 in equipment. And I literally told him, I said, sell your equipment for 650 grand. Because and we put it on the market and we tried to sell it and we got close. We had dozen, 2 dozen buyers that seriously looked at it. But there is a situation that occurs, especially with very capital intensive businesses like landscaping companies, where your equipment is worth more than your business.
Sure.
And your easiest route in that situation is just to sell the equipment. What I normally find is the equipment actually isn't worth 650,
Right.
right?
Right.
Like they say. And
Right.
so they got to come to a reckoning with your business isn't
Sure.
worth 650 and neither is your equipment.
Do you
And
do the
so
equipment appraisals or do you refer that out? in a
I
situation.
refer those out. That's
Uh-huh.
definitely a specialty
Sure,
that you have to, be in to be an expert in that.
sure, sure. What about financial documents? Just there's specific documents that you are typically required to perform a valuation. You mentioned tax returns earlier, but there's so much more to it than that. Maybe you could just talk about that and how sellers could actually get to that point where their financials are clean, right? And how far they need to go back. And you were talking earlier too about discretionary expenses. I mean, would you say that that's similar to like normalizing your financials,
No,
and
yep. No, that's exactly right. This normalizing idea is kind of getting rid of those discretionary items. So generally speaking, it depends on, for doing a valuation, you generally go back 3 years. And
sure.
as we were discussing before we got on here, if you've got a sophisticated modeling system where you can actually go forward with your projections, really what buyers are looking for is they're wondering what's going to happen in the future. Um,
Yes, of course.
you know, and they're looking to the past to hopefully see that it's going to be replicated in the future. But if you've got the ability to forecast, in a perfect scenario, it would be like 3 years of previous financials, clean, you know, 3 years of clean financials in the past, and then really 2 years of forecasting. And I tell my sellers all the time, I say, if you've got a forecast that you can articulate and explain why and show that, hey, guess what, we implemented this a year ago and we've had this progress over the last year, and we're expecting, and it's concrete, and we're expecting this progress over the next couple of years. I can sell that to a buyer, right?
Mhm.
As a business broker, I can sell that to a buyer, but it has to be grounded in reality. It can't just be made up.
Right.
So back to your original question, kind of 3 years of previous financials on accrual basis is really the best. If you got 2 years of projections, that's really good. And then besides that, obviously you could do some interim financials. So let's say it's July, maybe your January through June financials to confirm that the current year is staying on trend. And then other than that, it's just this idea of maybe like an equipment list. So what equipment do you have? Really, an equipment list creates a floor for what your business is worth, because at a minimum, you can liquidate your equipment, right? That's the least amount that your business is worth. And then the other aspect of it would be an inventory analysis. And again, depending on your industry, that inventory analysis can be very complicated, or it doesn't have to be complicated at all. But those are the main pieces that go into business valuation.
So what if you're a professional services business and you don't have equipment or inventory?
Yeah,
Is
that's
it,
great.
yeah, is that like, I'm assuming that the valuation is weighed heavily on the customer or client list. If we're talking services, we're talking clients, right? So
Mhm.
the clients and the client concentration and how long they've been around and all of that.
Yeah, so I've got a situation right now where I'm dealing with that. So you have to
Mhm.
remember, all valuations are based off of the cash flow of the business, all
Sure.
business valuations. So again, if you've got a business that makes 100 grand a year and you got $1 million in assets, um, you're going to sell the $1 million in assets. You're not going to try to sell the business. Okay. If you're trying to get the most amount of cash. Okay. If you don't care
Mhm.
about your employees or your customers or your vendors, you just liquidate the assets. On the service business side, still a multiple of cash flow. This is true with any business, whether it's service related or not. Customer concentration is huge. So I've got a business that I'm selling right now. It's under contract. And in 1 month, I had 225 buyers. We had 25 offers, and we had 10 interviews with buyers. And one
Wow.
reason, yeah, yeah, it was really great. And we're still working through the closing. We're going to get there. But the reason we got 25 offers was the quality of the customers. And this is a service business. There's literally $100,000 in assets, and we're selling it for north of 2.5 million. Okay, so 100,000 in hard assets.
Mhm.
So the reason that it's so valuable is that there's no customer that's over, let's say, 6 or 7% of sales. Okay. And the industries that the customers are in are very diversified. So you've got service industries, you've got retail industries, you've got construction industries, you've got manufacturing industries. So there's no customer concentration with any single customer, and there's no customer concentration in any single industry. And so when the buyers saw that, that basically means that the revenues of this business are going to continue on no matter how the economy performs. Um, when the buyers saw that, they just jumped all over it.
Yeah, I bet they did. I bet they did.
Yeah.
I know too, you had mentioned a particular client story that I thought was very interesting, and I would love to have you share that before we run out of time here.
Oh,
And kind of going back to that whole valuation conversation where most of the time the owner thinks that the business is actually more valuable and more sellable than it is. But this particular story was the reverse of that.
yeah. So this is a really great guy. We're still friends to this day. And basically, I love one thing I love about business in America is that you might be rolling by and you look at a building and you just think, yeah, this is just an average business. And then you go into it and you look at the numbers, you're like, wow, this guy's making a lot of money. And so I did a valuation for this guy. It took a long time for the process of earning his trust and earning his respect and being able to represent him on the sales side. I got it on the market and it literally sold. It was one of my quickest closings. It sold in like 3.5 months. It took us about a month to get a buyer, and then that buyer closed within 2 months on it. It was
Wow.
a strategic buyer with a private equity kind of slant. So a lot of money, love the industry. So we're at the bar after the closing, and the seller invited all of his employees and all of his family, and he was just ecstatic because his business had grown very rapidly, and it was just a huge burden for him. And so he comes up to me and he says, Jacob, when we signed that listing agreement, I never thought you'd sell my business. He said, I thought this is too much money. It's not worth this. Nobody wants this headache. Nobody wants this.
Oh,
And and literally within 4 months later, here we are, having a celebratory beverage.
nice.
And he was ecstatic, and he's still ecstatic about it. We're still friends. It was really great.
Wow, that's fantastic. Yeah, that's a life-changing experience that you were at the helm of. So kudos to you. Yeah, and
Yeah.
credentials that you have, right? They're not just like on ice. You actually use those in your work and use them to make a difference in the lives of your clients who are privately, owned company owners. And yeah, so super cool. Love that. Love the mission. Um, let's talk real quick about intangible capital. And we kind of alluded to it earlier in the show where you talked about customer lists, but there's a lot more to it than that. And again, like as you said, emphasizing the fact that cash flow is the number one thing. But when you're talking about growing value in a company, aside from profitability and cash flow, what would you say are the number one or two things that really drive value in a business today?
Yeah. So when people ask me, what can I do? What should I do over the next 3 years to make my business more valuable, to make it so that I can sell it? Because there's a real concern with some businesses that you can't even sell it. And I tell them that the number one thing you can do is make it so you don't have to sell the business.
Mm,
Make it so that you're indifferent on whether you sell it or not. And for a lot of business owners, that comes down to getting out of the business. Because most businesses that I can't sell, it's because I can't get anybody to buy a job. Right? It's
yes.
very difficult. It's very difficult to get somebody to buy a job because you can get jobs for free. And the best thing about getting a free job is that you can quit whenever you want. Um,
Good point. And
right?
a lot harder to quit a business when you own it.
I was just talking with an owner this morning, and talking about how when times are rough, he sometimes wonders, and you can't quit it. And so the main thing that I tell people is to make it so that you don't have to be in the business and to work on getting yourself out of the business. So if you've got a good cash flow, the good cash flow will kind of set your price point of what your business is worth, and then making it so you don't have to sell, making it so you've got key employees and you're not doing the work day in, day out work. That'll make it so you're actually able to sell.
Yes. Yeah, we all want options too, don't we? For sure.
Yes.
Well, this has been great. Jacob, we are out of time, unfortunately, but I sure appreciate you sharing your advice. And this has been a really good conversation. It's been a while since we've talked with someone like you about valuation, because that's such an important part of being able to sell successfully and understanding how it actually works. So thanks again for joining us, and hopefully you can join us again in the future.
Oh, yes. Yeah, I'd love to.
Awesome. And thanks to our listeners and our sponsors. We appreciate you so much. Please do join us again next time.